we will be discussing our non-current assets. As well as non-current assets, we will be discussing our depreciation methods, how the depreciation is being done. So when we are talking about, when we start our topic, let's discuss first of all investments. Okay, I hope the voice is very much clear. If there is any distortion in the voice, you guys can tell me. So if the voice is clear, can you guys hear me?
Yes, sir, we can hear you.
Yes, sir.
Okay, now let's start with the word investments. Now, the word investment, and when we are talking about investments, this concept is basically twofold. Okay, you need to understand the concept behind when we are talking about investments. Okay, so let's first consider a basic diagram. We have two companies. Let's suppose this is an ABCN company, and we have an XYZN company, right? Now, basically, this is a workshop which we are trying to provide you with certain amount of knowledge in a certain time. So there are some concepts which needs to be understood before we can reach this. We can start this topic. So this diagram basically is trying to create that background, that contextual background, that scenario where you will be able to understand the word investments and what there are two types of basically investments. One is an equity investment and the other is the debt investment. Okay, that the investment in debt instrument. So let's suppose we have two companies here, XYZN company and ABCN company, and we are considering that the XYZN company has two instruments which is an issue. One are the ordinary shares and the other is the debt instruments, or you can say those are the loan notes. You can also consider them the loan notes. You can also consider them loan stocks. You can also consider them bonds. Normally, these are alternative terminologies for the same thing. So let's just first consider what are ordinary shares. Ordinary shares are basically these are securities which provide the ownership in the company. If you have bought an ordinary share of a company, you have the capacity to be a part of the decision making process. Okay, you can appoint, you can take part in appointing the directors, in dismissing the directors, and you can also take part in amending the memorandum of association and the article of association, going for special resolutions as well. Okay, one of the most salient features and the most prominent feature is that you have the capacity to appoint the directors, and the directors are that person who is basically managing the company on behalf of the shareholders. Okay, he is the agent and we are the principal. When we are talking about the loan notes, so what is the loan note? Okay, or what is a loan note or a bond or a loan stock? What is it? In some terminologies in Indian and Pakistani books, it is also known as debentures. So, okay, so what is it? It is basically again a contract. Okay, this contract has a face value or a par value. Okay, let's just consider the value is $100 at the moment. So it has an issue date. What is an issue date? If you buy the contract, you are basically lending the company a certain amount of money, and what the company is doing, the company is giving you this contract in return. Okay, now you have the capacity that you have invested $100. So you suppose you're going to get a rate of interest on this contract. Okay, how much would you get? Let's suppose the rate of interest, or it is also known as the coupon rate, also known as the coupon payment, is 6%. So annually you will be getting 6% on this loan. Okay, and the company will need to pay this 6%, and the person who has invested this $100 will be getting 6% from the company. All right. So there will be an issue date. There will be a redemption date. What is a redemption date, sir? Redemption date is the date on which the loan will be repaid by the company to the investor. Okay, that can either be done at a par value, that can either be done at a discount value, that can either be done at a face value, that can either be done at a premium value. So what we are considering, we're keeping the scenario very much simple at the moment. We will be considering that the company has invested $100 and the company is going to give back, will get back $100. Okay, what we have invested $100 and what we're going to get back is $100. Okay, for example, the term of the loan was 5 years. So for each year, the person will be getting $6. Okay, and after 5 years, the $100 will be repaid. So what we are considering at the moment that XYZ and company has two instruments, two type of instruments available in the market. One, it is ordinary shares, and other it is its loan notes. And ABC and company, being another person or being another entity or being another artificial person, has acquired both of these instruments. ABC and Company has an investment in its ordinary shares of the XYZ and Company, and ABC and Company has an investment in the loan notes of an XYZ and Company. So, from the perspective of XYZ and Company, the ordinary shares are basically our equity instruments. This is from the perspective of the XYZ and Company. And from the perspective of XYZ and Company, the loan notes are basically financial liabilities. Why it is a financial liability? Because XYZ and Company has taken a certain amount of money from ABC in terms of these loan notes. Okay, so these loan notes will be repaid after 5 years. The amount of these loan notes will be repaid after 5 years, right? So that's why it's a financial liability. It's an obligation for them. But from the perspective of the ABC and Company, the ordinary shares and the loan notes, both of these are investments. And these investments are in the form of equity instruments, and these investments are in the form of your debt instruments. So basically, these investments are also known as your financial assets. They are known as your financial assets. So basically, there is only one contract. Either that can be ordinary shares, or either those can be the loan notes, or those ventures, or those can be any other thing. Okay, but that same contract is either a financial liability or an equity instrument for the one entity, and the same contract is a financial asset from the other entity's perspective. Very easily, if I put it to you, the company who has invested certain amount of money from that company's perspective, that is a financial asset, and the company who has issued those instruments can either class them as equity instrument, or can they can either class them as financial liabilities. Okay, so this is the background of the current knowledge which you guys need to understand. Now, when we are going for the overview of the investments, we need to understand a few things. These investments are basically, as per IFRS 9, these are your financial assets. All right. And there are two types of investments, or you can say there are two types of financial assets which are normally considered. One, it is in the form of equity instruments. Either you have invested in the ordinary shares of the other company, or either those are debt instruments. Either you have invested in the loan notes, bonds, loan stocks of that particular company. Okay. So then when we understand this, another thing which we need to consider is, which I had already discussed in the previous lecture, that if anyone does not know what is an equity or what is an equity instrument. So the definition of the equity instrument is basically, it evidences the residual interest of the shareholders in the assets of the company after deducting all of its liabilities. Okay, so this is basically an equity instrument. So first of all, there are two types of investments which we need to understand. That investment can be either in the form of equity instruments, and that investment can be either in the form of your debt instruments. Okay, another thing which we need to understand already, that the book has classified that the investments or either the debt instruments, or either that is the debt investment, or either it is the equity investment. They can be available in they can be available for the trading, means they can be in the secondary market, or there can be a private place. Okay, so the accounting treatment for both of them is very much different. It is, if it is listed, if it is a listed company, and the debt is a public debt. Okay, and the shares of the company are being traded in the open market, then the accounting treatment is very much different. Okay, but if it is a private company and its stocks and its debt instruments are not traded, are not listed, then the accounting treatment is very much different, because the fair value of both of the instruments would not be reliably measured. So if the fair value is not reliably measured, then it creates certain complications in how to measure and subsequently measure these instruments. Okay. So first of all, what we are going to do is we are going to discuss the debt instruments or the debt investments. Okay, I have one particular question again. I'm asking all of you that, do you guys have any kind of an issue regarding the terminology of the bond, the loan stock, the loan notes, or anything? If you do have any kind of a problem regarding this terminology, you guys can ask me at this moment. Okay, so you guys understand what I'm trying to say at the moment. Utam Malik, I think this is your first session. You weren't available yesterday. Do you understand what I'm trying to say? Think he's not available. Abid Virani, is my voice clear to everybody?
Yes,
Yes,
sir,
sir.
your voice
Yes,
is clear.
voice is clear. Yes.
Okay,
We can hear you clearly.
okay. Mr. Malik says I'm okay, sir. All right. So let's just consider our debt instruments first of all. So just a little bit of theory, then I will be going for the um, we'll try to explain all of you on the one note. Just want to discuss a few things for you guys, because you guys need to read the book to understand the conceptual background of all of this. So give me a minute. It's basically quite easy. But what they have done, they have combined so many topics in a single topic. All right. Let's start from here. This is 1C, Unit 12A2, Investments Overview in Debt Securities. Okay, investment overview in debt securities. So what we have done, we have already discussed this. We have discussed our debt securities. We, however, discussed our equity securities. We have discussed our marketable debt securities, and equity securities. Okay, now what he has done, what the book has done, the book is basically made a bifurcation between equity securities. Okay, what he has done, that there is a certain amount of investment which creates a significant influence, and there is a certain amount of investment which does not create a significant influence. For example, what is he trying to say here? He's trying to say that, suppose company A has acquired 10% of the ordinary shares of the company B. So, if you have acquired 10% of the shares of the company B, this 10% holding in company B does not create any significant influence in the company B by the company A. For example, let's suppose company A has acquired around 30% of its ordinary shares in company B. Now, the scenario changes, right? What does happen now? If you have acquired 30% of the ordinary shares of the company B, that creates a significant influence by the company A on company B. What happens? Company B will be compelled. So, company B will be compelled to give an offer or offer certain positions to either the directors of company A, or they would be compelled. Meaning, the simple the terminology is that company A has a significant influence over them. So they will be able to participate in the decision making process. They will have a certain representation on the board of directors. And that certain representation on the board of directors will be able to influence other board of directors to take a certain decision regarding company A. Either that is related for their trade purposes, either that is related for their debt purposes, whatever it is. Okay. Now, a third scenario which the book discusses is whether company A, let's suppose company A has acquired 60% of the ordinary shares of the company B. Then what happens now? We have more than 50% of the ordinary shares of that company. So basically, here, this is not creating a significant influence. Basically, the A becomes the parent company and B becomes the subsidiary company. And here, the individual financial statements of company A and company B will be consolidated, right, sir? Once they are consolidated, we will create another problem. If the consolidation is being done, IFRS 10 will be used. International Financial Reporting Standards, IFRS 10 will be used. And I, IS 27, some features of IS 27 will be considered, as well as the business combination will also be considered. So, in these circumstances, the company A will become the parent company, the company B will become the subsidiary company, and both of these companies' individual financial statements will now be consolidated. And both of these companies will now be considered as a group. They will now be considered as a group. Okay? So, these are the things which the book discusses here, but it does not provide any kind of a diagram. Neither there is another problem which I have considered, that the book does not provide any kind of a mathematical example in how to calculate this. Okay, so we will also discuss a part of mathematical examples, a part of financial examples on how to calculate certain features of this. Okay. Now, what we are discussing here, that is investments overview, and this will be considered as our debt securities. Okay. So there are basically three types of debt securities. Either they are held to maturity, either the intention of the company is to hold them till maturity. Let's suppose if the loan notes for 5 years, and the acquiring company, what the company has acquired them, has an intention to hold them till maturity, means they are holding the loan notes, the bonds for the 5 years, for the term of the contract, for the term of the bond. So that will be held to maturity. So how will you measure them? How will you recognize them? You will use the amortized cost. Now, what is an amortized cost? That is another problem for another time, but I will discuss its accounting treatment. Okay. Now, if the debt securities are held to maturity, but they are also available for sale, if they are also available for sale, if another opportunity arises and that opportunity provides the company, the acquiring company, the investor company, with the option to sell these debt instruments and buy other debt instruments with higher return, then these are known as available for sale securities, and you have to measure them at fair value. And that fair value, that change in fair value, will be recognized through other comprehensive income. It will be considered your unrealized gains and losses. Okay. Then again, no working has been provided on how to calculate this. Only a description has been given in the coming sections. Then there is fair value through income statement, that is in the form if the debt instruments are classed as trading security. Okay, they are available for trading. You want to hold them for less than 1 year. They are available for trading. You want, if there is a gain in them, you are ready to sell them. So in these circumstances, they are again measured at fair value, but here they are not amortized. They are only measured at fair value, and any gain and loss in them are recognized in the profit and loss account. Okay, so then there are certain circumstances which the book is discussing regarding, let's suppose, costless impairment if any adjusted or observable price changes. That is in the case that if the equity securities are not traded in the open market, or not available in the market, or not have an active secondary markets. Then there is an equity method. Equity method is basically discussing the same thing which I have already discussed here. That is in the case if company A has acquired company B and the ratio is around 30%. Basically, the equity method is used when the holding is between 10 20% to 50%. When the holding is between 20% to 50%. If it goes above 50%, then there is no significant influence, but when there is control. If it is less than 20%, again, there is no significant influence. So for the significant influence, it needs to be between 20 to 50%. Now, this is what it has been discussed here. And if you are going for consolidation, then there should be control. And where there is control, the ownership is in the ordinary shares is normally more than 50%. Okay. So this is what it has been discussed here. So if there is any question for you guys, you need to ask me here. Any question? Anyone? No one is
Sir,
willing to.
so it's a significant influence. So it will be equity methods, are right?
Right. Yes, there will be an equity method. That is
Equity
basically
method.
considered as an investment in associate.
Okay.
Okay.
It will be treated as associate. Yeah, okay, understand.
Yeah. Yes,
So
that will be considered as an investment in associate.
okay. So, sir, would you like to go in depth for some, because in CMA syllabus, I think it has been introduced, the consolidated financial statement. If you go in depth some parts, it will be beneficial for us.
It would be beneficial for you, but I think we have a current problem that I only have this session and that is for 2 hours. So I would
Okay.
not be able to cover everything. But what I can
Understand.
do for you, what I can do
Yeah.
for you, I
Yeah.
can give you a certain performer regarding how the investment in associate is basically accounted for. Okay. I can give
Okay.
you a certain performer which you will be able to understand. So
Okay.
let's just
Okay.
consider if that is an investment in associate. There's an investment associate. So how would you account for? You would write cost of investment,
Yes.
and you would add any post acquisition changes in net assets.
Okay.
These can be considered, brother. These can be considered as post acquisition profits. Because if you know your accounting, you would know that the change in net assets are normally because of two things. Either they are because of the change in equity, either they are because of change in reserves, or either
Yes.
that is because of change in profits. Okay, so
Okay.
what you are going to do is you're going to take the post acquisition change in net assets. Again, one thing that you should consider is the word that I have used, that is the post acquisition. What is meaning by the word post acquisition? Post acquisition means after acquisition,
After
after
taking
the
over of the,
acquisition.
yeah, after
Yes,
the acquisition, yes.
after acquiring those shares. Okay,
Yes.
and then you're going to
Yes.
multiply it with the percentage hold. Okay,
Okay.
certain amounts are deducted, such as there and if there is an impairment loss as per IS 36 or as per US GAAP. Both allows impairment loss. You're going to deduct that impairment loss, and
Okay.
if there is any unrealized profit, that is also deducted. This is the amount of investment in associate
Associates, yes.
using equity account.
Authority.
This is the amount which will be taken to the consolidated statement of financial position. This amount will be taken to the consolidated statement of financial position. Uttam, if I'd like to add something to you, just listen to me for a second.
Yes, sir.
One thing, the book which has not identified here, that the equity method is only used when the acquiring company has a subsidiary. Okay, you need to
Okay.
understand. Meaning, let's go on a little bit depth here. For example, we have a company A which has
Oh,
acquired company B around 70%. So here,
yes.
A company is the parent company and B company is the
Is
subsidiary,
subsidiary company, yes, correct.
right? So
Yes.
A company has also made another investment. Let's suppose in company C.
Yes.
And in this company, the company A has only invested 35% of its, has acquired only 35% of the shares of company C. Okay.
Yes.
So
Okay.
when the parent company will be preparing the consolidated financial statements with its subsidiary company, how will the
Yes.
parent company account for the investment in associate? It will use the equity accounting.
Equity account.
It will use the equity account. This is basically the equity. Agreed? So
Yes, correct, sir.
this is very much in detail, but why I have discussed to you.
Thank you. Thank you so much.
No issues. Okay, so what it has discussed here, that we were discussing our debt instruments. So there are three measurements available. Okay, and those measurements, again, I'm telling you, will be based upon the intention of the investor. Okay, that they will be based upon the intention of the investor. How is he viewing those debt securities? Either he wants to hold them till maturity, either they are available for sale, or either they are available for trading. Okay, so how will you account for them? I would need 1 minute of you guys, because I would need to close my sharing for a second, and then I will be back and I will be able to give you guys a question, and we will solve the question. So you guys will be able to understand the whole procedure through which the question was obtained, which was completed, and what is the accounting treatment, and what are the double entries that will be done to account for certain securities. Okay, so 1 minute only.
Yes, you can ask the questions. I am available yet.
Okay, let's start again. I'm back. So let's consider a question here, that is Tokyo. So, right, everybody, let's start reading it. This is, I think, screen is sharing, everyone. You guys are getting the screen. My voice is clear. Any problem? Anything?
No, sir.
Okay. All right. Mishal is even back. On 1st of January 2001, Tokyo bought 100,000 5% bonds at 95,000, incurring an issue cost of $2,000. Interest is received in arrears. Okay, the bond will be redeemed. Again, you need to understand the certain language of the question. The language say you have bought these shares. Okay, so this is an investment. This is the face value, 100,000. This is the coupon rate. The par value and the coupon rate are normally written side by side. So when you are acquiring these debt instruments, what you are getting, you're going to be investing about $100,000, and on those $100,000, you're going to be getting 5% rate of interest. Okay, bonds for $95,000. Now, what is meaning by this word, that you have acquired certain amount of bonds which has a value of $100,000, or which has a face value or a par value of $100,000, but you have acquired them for $95,000. Okay, it means they are selling these bonds at a discount. Incurring an issue cost. What is an issue cost? Normally, this is the administrative cost, or the cost which is incurred through a broker or an agent, whoever arranges for the purchase of these debt instruments. He charges certain amount of commission or a certain amount of fee on such purchases. Okay, so the administrative cost, or the issue cost, or the commission on the purchase of these bonds is $2,000. Interest is received in arrears. That means that interest is received at the year end, and the bond will be redeemed at a premium of 5960. Means at the end of the day, meaning how long will it take? The bond will be redeemed at a premium on 31st of December 2003. So 2001, 2002, 2003. It is a 3-year bond, and when you are going to get back your money, you will not get $100,000, but you will be getting $105,960. Okay, you will be getting $5,960 in terms of your premium. So that is basically premium on redemption. The effective rate of interest is basically 8%. This is the IRR of this bond. And the fair value of the bond was as follows. On 31st of December 2001, it is $110,000. On 31st of December 2002, it is $104,000. What is required? Explain with calculations how the bond will be accounted for over the relevant years. If the Tokyo's business model is to hold the bonds until the redemption date, yes. What does this line means? This line basically means the intention of the Tokyo, the intention of the investor is to hold the instrument, is to hold the bond, is to hold the debt instrument till maturity. Redemption date means the date on which the amount of the bond will be repaid by the company towards Tokyo. The second requirement, or the second scenario, is Tokyo's business model is to hold the bond until redemption, but also sell them if the investments with the higher return becomes available. Okay, it means it also wants to hold them, but it is also available for sale. And the third is it is available for trading in the short run. So we will be able to measure them at fair value, but any change in the fair value will be measured in this, it will be charged to the statement of profit and loss or the income statement. Okay, so take a minute and read the question again, everybody. Take a minute and read the question. All right. So, does anyone have a calculator in his hand? Does anyone have a calculator in its hand? Any person who wants to do the calculation?
Yes, sir.
Okay. Afzal, would you do me a favor? I will be telling you and you would be doing the calculation. Okay.
Okay, sir. Sir. Okay, bro.
What we are going to do is we're going to initially record our bond. So it is initially recorded as fair value plus any issue cost. And basically what does this line mean? This line means it is measured at consideration paid. So what is the amount of consideration which you have paid? You have basically paid, what you have paid is you have paid the fair value, that is the $95,000. And what is the issue cost? That is $2,000. So at what value will you be recording it? That is $97,000. So investment in debt to bank, that is $97,000. Let's just consider, we are considering the first scenario. So how it will be subsequently be measured. I'm talking about how will it be subsequently be measured. So subsequently it will be measured. In the first scenario, it will be measured using the amortized cost. What is amortized cost? Very much simpler to a lease that we need to prepare a amortization schedule, balance at start, interest at the rate of 8%. This is the effective rate of interest. Here you will put the coupon rate, that is the 5% or 6%, if I'm not wrong. Let me check.
Yes, sir. 5%.
It is 5% and the balance at end. Okay. So the balance at start is bond needs to be 97,000. What is the effective rate of interest? 97,000 multiplied by 8%. What will be the value?
7760, sir.
Can you please repeat?
7760.
7760. Okay. Now the coupon rate is normally calculated on the par value. The par value is $100,000 and $100,000 multiplied by 5%, then that would be $5,000.
Yes.
So this is the amount which is paid or received, you can say. Okay. Now this is basically the column A, this is B, and this is C. So how are you going to calculate D? You're going to add A plus B, and you're going to deduct the column C. So what will be the value at the end of the period?
97 or 776
97,000 plus 7,760 minus 5,000.
minus 5000. 99760, sir.
99760.
Zero.
Right. 99760 multiply by 8%.
7980.8.
7980.8.
Yes,
So
sir.
let's round it off here and
81.
write 1.
Yes, sir.
5,000. Again, it is the coupon payment will be the constant one. So what is the value at the end of this period?
1 minute, sir. 99.
760, 7,981 minus 5,000.
So 102741.
102741
41. Yes, sir.
10 sorry 102741 multiplied by 8%.
8219.28.
821.28,
9.28, sir.
5000.
Yes, sir. Again, add, sir.
Yes, just do the closing balance, calculate the closing balance, please.
1, sir. 8219. 105960, sir. 60,
105960.
sir.
Where have you seen this amount before?
Sorry, sir.
This is the value on which the bond will be redeemed, because the question says at redemption date on 31st of December 2003, you will get your par value plus $5,960 back. So what you will be getting back? You will be getting 100,560.
Yes.
This is the amount which has been, we have already arrived to this. So this is our asset at the moment. What we are going to do here, another thing which needs to be discussed first. Just make a total of this column, the column B.
Okay, sir. So 23960.
23960. And
Yes.
this has a total of 15,000.
15.
Deduct
Yes.
both of these values.
So 8960. 60, sir.
8960. Okay. Just one more thing. How much did you guys invested in these bonds?
97,000.
97,000.
Yes.
At redemption date, what are you getting back? You're getting
8930.
a face value that is 100,000, plus you're getting a premium that is 5960.
Yes.
Okay. So what you are getting is this amount, right?
Yes.
Take a difference of these two amounts.
105960 minus 97.
8960,
Yes, sir.
that is the same amount, brother.
Yes.
That is the same amount. Basically, this is the interest which you have amortized effectively over the 3-year period. This is the interest income which you are getting and which you have amortized over the 3-year period. Okay. So you
Yes.
need to understand that this language is basically given in your book, given in your volume. So you will not be understanding by just reading that. So this is how your interest, the gain, is amortized over the period. That's why the effective rate of interest was greater than the coupon rate. Okay,
Yes.
basically this rate covers the discount at the issue of the bond, and it also covers the premium on the redemption of the bond. So I hope you guys understand. If we come here and we just read a certain amount of this, that is held to maturity debt securities. Debt securities classified as held to maturity are accounted for using the amortized cost and presented net amount expected to be collected using an allowance on credit losses. We have not discussed credit losses at the moment. Okay. Premiums and discount. You can read it. It is the same line which I have already discussed. Premiums and discounts are amortized as adjustments to the interest in. So if we had not done this question, you guys would definitely be not be able to understand what I'm trying to say here. If the management has an intent and ability to hold the securities to the maturity date, changes in the fair value, market value, and the securities holding period are not relevant. So securities are not adjusted to fair value during the holding period. Interest income, including adjustment for amortization of premiums and discounts and realized gain and losses, are reported as net income. This amount, the column B, this is the net income. This will be taken to the statement of profit and loss as net income, and this amount is the value which will be taken to the statement of financial position as a non-current asset, and at the end it will be considered as a current asset. Okay, the second thing is available for sale securities. All right, so available for sale securities, what we are going to do for available for sale securities. Now if we go towards the question again, basically what the question does, it is using one scenario and it wants me to solve the same scenario either if the bonds were held to maturity or either the bonds are available for sale. So the second requirement is basically giving me an opportunity to solve the same question by using the different models. So what I'm going to do, I'm not going to solve this, but I'm going to go for the key or go for the answer and discuss it, because everything is same with the minor changes in it. What are those minor changes? So this was the requirement A, which we have already discussed, which we have already calculated. So this is requirement B. Now, what we are going to do, the value at which the bond was recorded is the same. It is the amount that was 97,000. In the previous working, it is the same. It is 97,000. The interest value will remain the same. The receipt value or the coupon payment will remain the same. The closing balance will also remain the same, but there will be a certain amount of change in the first year. Now, what happens? The value at the end of the first accounting period is $110,000. So this is the carrying value, 99,760. The fair value is $110,000. So what we are going to do is we are going to create an unrealized gain by $10,240. Okay. Now this opening balance, this closing balance will be considered an opening balance for the next year, but the interest payments will remain the same. The effective rate of interest will remain the same as per the previous. Okay. The receipt will be same. This is the closing balance. Again, at the end of the second year, the value is $104,000. So any gain that the previous year there was a gain of 10,240. This year, because the carrying value is greater, but the fair value is less than the carrying value. So we would need to reduce the value of that financial asset. We would need to reduce the value of that investment by 8,981. That's why there is a negative sign. Again, what we will do, the closing balance will become the opening balance. The effective rate of interest will remain the same. And this will be the closing balance. So any amount of difference between the closing balance and the value will be taken to the other comprehensive income. So when we go towards our the book which has been discussed, let's come here to this point. Interest and realized gains and losses are reported in the net income. This is already okay. Premiums and discounts on available for sale debt securities are amortized as same as premiums and discounts on held to maturity as debt securities. However, now here the difference is basically explained. However, unlike held to maturity debt securities, available for sale debt securities values on balance sheet are adjusted to the fair values at the end of each reporting period. So you can very much clearly see, brother, and all of my contributors, that this is basically the carrying value and this is basically the fair value. So the value is basically adjusted, and any adjustment is taken to the other comprehensive income, also known as the OCI. If there is a gain, how that gain is recorded, I will tell you. The investment in debt instrument is debited and OCI, other comprehensive income, is credited in the case of a gain. And if there is a loss, then what you're going to do is you're going to debit your other comprehensive income, and investment in debt instrument is credited, and that will be the loss. Here, another thing which you guys must realize is whenever the other comprehensive income is either debited or either credited, the book basically denominates it as a unrealized gain or loss. The book predicts it as an unrealized gain or loss. Okay, so you need to understand that. What is the third requirement? The third requirement is very much simple. The bonds are available for trade and they're available to be sold in the short term. So any gain and loss will be taken to the statement of profit and loss. They will not be amortized. They will only be. They will not be amortized. They will only be remeasured at fair value at each reporting date, and any gain and loss will be taken to the statement of profit and loss, and that gain and loss will be realized in that accounting period. Okay. So the same thing is being done here. This is what it is going to be doing. We are going to measure it at fair value 95,000. Any transaction cost in this model will be charged to the profit and loss account, and the fair value is $95,000, and here the value is $110,000. So the gain of $15,000 will be taken to the statement of profit and loss. Next year, the same thing will be done. And if we come here and discuss this here, trading debt securities. Trading debt securities are debt securities that are bought and held principally for the purpose of selling them in the near term. That's why we use this model, because it is here, it is discussed that the bonds are available for sale in the short term. And therefore, held only for a short period of time. Trading generally reflects actively and frequently buying and selling and trading. Trading debt securities are accounted for at fair value with interest in realized gain and losses and unrealized gain and losses, all being reported to the net income. Fair value adjustment during the holding period are debited and credited to the trading debt securities and transferred to the profit and loss account and in the income statement. Okay, so I think I have quite extensively discussed these overview of investments in debt securities, and as well as the investment in the equity investments. Okay, so let's just consider we need to discuss another few things. Just before I move ahead, if the class has any question. If anyone has any question, I'm open for the questions. Yes. Abdul Rafi, Afzal Khan, Utam Malik. Anyone? You guys have any questions?
No,
No,
it's
sir.
okay, sir.
Okay, you getting my point? Is the workshop helpful or not?
Yes, sir. Yeah, yes, sir.
Yeah,
Sure, sir.
definitely, it's helpful, sir. Definitely, it's helpful.
Okay. All right, Abdul Rafi, no questions. Okay, so when we are going to discuss our equity investments, so investment in equity securities, there are method 3, 4, and 5, and 6. So basically what it is going to discuss is someone asking a question. All right. So investment in equity securities may be investments where the investor does not have a significant influence or may have a significant influence, or it is for the purpose of consolidation. So the same things have been discussed, which I have already discussed, that either it creates a significant influence or either it does not create a significant. If it is less than 20% or up to 20%, it does not create a significant influence. If it is between 20 to 50%, that creates a significant influence, and the equity accounting will be used, and it will be considered as an investment in associate. On the other hand, if it is greater than 50%, then it will be considered as a gain, and it will be considered as an investment in a subsidiary. And for that person, there's a control in that company, and consolidation is normally used to account for those investments. Now, let's just consider if the investment is less than 20%, for example. So, investment in equity instruments, or you can say financial assets in equity instruments. So, what you're going to do here, the book follows two models. Either it is known as fair value through profit and loss account. These are those investments, these are those ordinary shares, these are those equity instruments which are available for short term trading. Okay, or either you can get them at fair value through other comprehensive income. There is an abbreviation for both of these models, that is fair value profit and loss account, and the other is fair value through other comprehensive income. Okay, in the fair value through profit and loss account, in this model, the initial measurement is done at fair value. And what is the fair value? That is the consideration paid. And the consideration paid does not include any issue cost or transaction cost, is not capitalized but charged to profit and loss account. What is the subsequent measurement? Sorry. The subsequent measurement is done again at fair value with any gain or loss taken to statement of profit and loss count. Very much simple. On the other hand, if we are using the fair value through other comprehensive income, if we have invested in a company and our intention is not short term, it is long term. So we need to take the model of fair value through other comprehensive. In this model, what will we do? We will, our initial measurement will be at fair value. Here, the fair value will be consideration paid plus issue cost. The issue cost and the transaction cost will be capitalized. It will be capitalized, meaning it will not be charged to the profit and loss account, but it will be added to the value of the investment. How the subsequent measurement will be done? It will be done again at fair value, but this time with any gain or loss taken to the other comprehensive income, comma, as a investment reserve. Sir, please explain. We didn't get the investment reserve right. So, if there is a gain, financial assets will be debited and investment reserve will be credited. And if there is a loss, then investment reserve will be debited and the financial asset or the investment in equity instruments will be credited. Okay, that is in the case of a loss. So I think what I have done, I have extensively covered everything regarding the equity instruments because we have a limited number of time here. So it is not possible for me to go into each and every bit of detail that is available in the book, but I'm trying to do my best to cover every part of what Daniel has told me to cover. So I hope you guys are understanding what I'm trying to say here. So let's go towards the last part of our workshop, and that is basically our non-current assets or fixed assets. Yes, can anyone tell me what are non-current assets? Any idea? Or you can also consider the fixed assets.
Non-current assets are like depreciation, sir.
Can anyone tell me what are non-current assets or fixed assets?
Depreciation, non-current asset.
They are the same thing.
Depreciation is non-current asset. Fixed assets is our plant, machinery, other fixed asset.
Uh, what's your name, brother?
Afzal.
Okay, Afzal, did you
Yes, sir.
attend yesterday's workshop?
No, no, sir.
You were busy?
Yesterday, sir, that time actually it's a Salah time. Today, no go to Salah, I am attend.
Okay, okay.
That is the
So
problem.
next time we will consider a time which is not a Salah time. Where are you at the moment residing?
Saudi Arabia, sir.
Okay, you are available in the Saudi Arabia. Okay. All right. Let's just consider a thing. Afzal, first of all, do you know what is an asset? Do you know what is the meaning or the definition of an asset?
Asset is the resource of business, sir.
Okay, very good. That is the word I was searching for. An asset is a resource which is controllable, from which inflow of future economic benefit is probable and cost is reliably. Mayan. Okay, so this is an asset. Another thing you guys should remember that the third and the fourth criteria is also the recognition criteria of the non-current assets. Okay, there are two types of assets by classification. Either those are the non-current assets or either those are the current assets. The non-current assets are those assets which provide us with economic benefits for more than one accounting period, or you can say we can use those assets for more than one accounting period, or you can say which has a useful life for more than one accounting period. Sir, what is
Yes.
a useful life? What a useful life is it's very simple talk. It's a very simple thing. What is a useful life? Useful life is basically the period over which the asset would provide us with economic benefits. Okay. All right. One more thing. What is an economic benefit? Does anyone have any idea? What is an economic benefit?
We have got profit from some this asset.
Yeah, we can simple say that the cash inflow,
Yes.
that is the economic benefit. In simple terms, in the most simple terms, the inflow of cash, that is the economic benefits. Okay. So normally, the non-current assets or fixed assets are those plant and machineries which are used in the production of goods, either supply of services, either they are used for administrative purposes, or either they are used for rental to others. These are those assets basically which are used in the business to earn or generate our revenues. Okay, so So there's a lot of detail available now. The thing is basically he was discussing business combination and consolidation. So IS 16 property plant and equipment, the same standard as per IS 16 here is that is AS 360, but the language and the wording is everything that is almost same. Okay. And the property plant equipment, also known as the fixed or capital assets, are land buildings and equipment acquired for operation and not for resale purposes. These assets are not available for resale, but these are the assets which are used to produce those goods which are then sold in the market to earn our revenues. For many companies, property plant equipment constitutes the largest asset classification on the balance sheet, and this is a normal thing. For the production of the companies and large production facilities, therefore, it is an important that the company correctly values and account for the fixed assets. The initial recording is normally done at cost, and all the directly attributable expenses in bringing the assets to a workable condition and the condition which from which it is in the intention of using the asset. Till that point, all of those costs are capitalized as a part of that asset. So fixed assets should be initially be recorded in accounting records at historical cost, which is the amount paid for the asset and all the other costs necessary to get the asset for ready for use. Okay. Means if we have acquired a plant from, let's suppose, China, and we have paid a certain sum of import duties and a certain amount to it, and there was some carriage charges and there was an installation cost. We had to take certain legal advisors in obtaining an NOC, and we had to create a certain benchmark or create a certain we had to prepare the foundation for that plant to be installed, and any electrical installation cost, and even testing the asset that whether it is available for use. All that cost is basically capitalized as a part of the cost of the non-current asset or that fixed asset. Okay. So here ASC 360 has discussed in the case of a building, in the case of a machinery, in the case of a land. Okay. So then again, this is one of the most differences between IS 16 and ASC 360, that the IS 16 just provides us with the principle, but here the standard has provided us with a detailed guidance. So here in the building, it says the purchase price, the cost of renovating, repairing the building, cost of all permits. Permits means NOC, any taxes assumed by the purchaser, insurance paid by construction building, and materials, labor, and overhead construction are capitalized. They are a part of the capital work in progress. In the machinery equipment, the cost of the machine, the freight in handling, taxes, testing, okay, the machinery installation, and any other cost in getting the machinery ready to be intended use. Again, this is the word which I used. Partial destruction of the machinery can be included if, for example, a wall needs to be torn down to install the machinery onto a factory floor. If a wall needs to be torn down to install the factory, the cost of the demolition and rebuilding the wall are included in cost of the machinery. Improvements are also included. Land, he says that land, the part of the land should be included if the land has any trees on it, and those trees are deducted and then sold. So the sale proceeds should not be recorded as revenues, but those sale proceeds should be deducted from the cost of the land. Okay. Then there is a concept of depreciation. So does anyone know what is depreciation? Does anyone know what is depreciation?
Depreciation is the so asset life, useful life. It depreciates the asset some amounts.
Depreciation is the systematic allocation of the cost of non-current asset over its useful life. Okay, systematic allocation. Now, this is a very fancy word which is being used, that is systematic allocation. Basically, suppose we have acquired an asset for $10,000, and that asset can be used for 5 years. So, what we are going to do is we are dividing this $10,000 into 5 parts, and we are allocating this cost $2,000 each year for a 5 year period. Basically, we have taken a capital expenditure and converted into a revenue expenditure over the period of use. Why we have done this? This is the question. Why we have done this? Because the statement of profit and loss is prepared for only 1 year. So it cannot include an expenditure which is for more than one accounting period. So what do? We break that expenditure into a 1 year expenditure and we charge it in the statement of profit and loss in the form of a depreciation. Now, the main concept, there are 3 to 4 methods which the book discusses how the depreciation can be calculated. One is the SLM method, also known as the straight line, in which the depreciation is normally constant. How the SLM is calculated, that is cost minus residual value divided by useful life. What is residual value? Please, sir, explain. The value of the non-current asset at the end of the useful life of the asset. At the end of the useful life, whatever the value can be estimated, that is the residual value. Okay, we have already discussed the useful life. Then there is the reducing balance method. In this, depreciation reduces by each year because the depreciation is calculated on the carrying value. So what is basically the carrying value? First, we will need to discuss that. A carrying value is basically if you deduct your cost minus accumulated depreciation from it, this is carrying value, also known as the net book value, also known as the book value, also known as the written down value. Okay. And the question goes forward, sir, what is the accumulated depreciation and how it is calculated? Basically, depreciation is debited and the accumulated depreciation is credited. Sir, again, we do not know what is meaning by accumulated depreciation. So the depreciation is an expense which is charged to the statement of profit and loss account, and the accumulated depreciation is a negative asset. Sir, what is a negative asset? It is a contra asset. Okay. And what is a contra asset? This contra asset is taken to the statement of financial position on the asset side and it is deducted. Okay. So in the reducing balance method, in the first year, cost multiplied by percentage of depreciation is multiplied and we get our depreciation. In the second year and onward, cost minus accumulated depreciation, the previous year depreciation is deducted, then carrying value and multiplied by percentage of depreciation. And this process is being done over and over and again, which causes a reduction in the depreciation. So that is known as a reducing balance method. Then there is a number of units of production method. So what is this? It is very much similar to a straight line method. Basically, for example, the formula is very much similar: cost minus residual value divided by useful life. Okay, but here things become a little bit complicated. Useful life is basically total number of units which can be produced. For example, we have acquired a plant for $10,000 and the plant can produce 5,000 units in terms of total and has a useful life of 5 years. In year one, the plant has produced 1,200 units. In year two, it has produced 800 units. In year three, it has produced 1,000 units. In year four, it has produced 1,500 units. And in year five, it has produced 500 units. So how will the depreciation be calculated? Again, I'm assuming that the residual value is $2,000. Okay, let's just consider another thing. We would the asset has a cost of $50,000. So how the value would be calculated? If we are using the SLM method, then it is very much similar. $50,000 minus residual value of $2,000. That creates a depreciable amount of $48,000. Divided by 5 years. Afzal,
Yes,
what
sir.
is this? 48,000 divided by 5?
1 minute, sir. 9600. 9600, sir.
9,600.
Yes,
This
sir.
is the depreciation. This will be the depreciation in year one, 9,600. In year 2, again 9600. In year 3, 9600. In year 4, 9600. And in year 5, 9600. Yes, the things will not change. This is an SLM method.
Yes.
Okay, this is a straight line method. Again, let's consider the same scenario, but for the number of units produced method. So what we're going to do is
Total produced, sir. Total 5 year
that is
produced.
48,000. This is the depreciable amount divided by 5,000 units.
Yes.
So what is the depreciation per unit? Can you tell me? 48,000 divided by 5,000 units.
9.6, sir.
9.6 per unit is the depreciation per unit. So
Yes.
in the year 1, 2, 3, 4, and 5. In the year 1, we produced 1200 units.
Yes.
By 9.6. In
Yes,
the
sir.
year 2, we produced 8 by 800 units multiplied by 9.6. In the year 3, we produced 1000 units multiplied by 9.6. In the year 4, we produced 1500 units multiplied by 9.6. And in the year 5, we produced. So, can you give me
Yes.
an answer?
1152,051.
1,
1. 11,520, sir.
11,520.
520. Yes, sir.
Next, please.
7,680.
7,680.
This is 9,600, sir.
9,600.
And this one 15, huh?
1,500 multiplied by 9.6.
नहीं, बिल्कुल भी नहीं।
14,400, sir.
14,400.
आपने चिकन डाला ना तो
Yes.
और माहौल बन गया। नहीं, मुझे जाएगा बाज पागल मेरा। क्या लेके? अब वो ऐसे सही चीज है।
500 multiplied by 9.6.
1 minute, sir. 4,800, sir.
4,800.
कहाँ से क्लास ले रहे?
Okay.
यूएसए
Yes, sir.
So 11,520,
एग्जाम है।
7,680. So basically, what is
नाम
depreciation?
ना मुझे खुद भी नहीं पता लेकिन इसकी वेटेज एसीसी से 10 गुना ज्यादा है सीए से। स्कूल वाले करवा रहे हैं कॉलेज यूनिवर्सिटी वाले?
Please,
यूनिवर्सिटी
sir,
में
off
टीचर
this.
करवा रहे हैं, उन्होंने मुझे कहा
After
था ज्वाइन कर लिया करना।
stop
मैं कहा अच्छा।
talking or stop your mic, please, for a second.
यूएसए वाले कर लेते हैं एग्जाम।
Nothing.
एमसीक्यू टाइप एग्जाम होता है। उन्होंने कितना स्कोर बनाया टोटल?
Okay. So what we are going to do, basically, what I'm discussing here, that the straight line method charges depreciation on straight line basis. On the other hand, the number of units produced method charges depreciation based upon the depreciation, based upon the charges depreciation based upon the number of units produced. So the logic behind this method is the the more number of units that you produce, the more machine you are using. If the more machine you are using, then the machine is being morely depreciated. So the expense for that particular time period should be greater than the from the previous time period in which the machine was used in a less manner and less number of units were produced, right? So this is a very straight line method, but meaning now again I would like to discuss one more thing, that the number of units produced is a more accurate method than the straight line method. Here, the assumption is that the machine is being used on a straight line basis. So the expense is being recognized on a straight line basis. But in practical, this does not happen. There are seasonal variations. There is also a business cycle variation in which a product in the early years of its introduction are being produced on a greater number basis than on the years on which on the लेस ईयर्स और आने वाले सालों के अंदर उसमें कम हो जाती है उसकी प्रोडक्शन. सो इन दोज ईयर्स less units are being produced. So the depreciation expense should also be proportionately being charged on a less basis. Finally, another method that is given into your books, that is the sum of digit method. This is another method of reducing balance basis, means it is similar to that, but it is more systematic. For example, we have an asset which has a useful life of 10,000, or sorry, which has a cost of 10,000, which has a residual value of $2,000, or let's just consider the value to be 50,000. Okay, the residual value is $2,000, and the useful life is 5 years, for example. So, what is the sum of digit method? You have 5 years. So, what you are going to do is 1 year, 2 year, 3 year, 4 year, 5. This creates a total of 1 plus 2,
n
3,
into n plus 1
6.
by 2, sir.
Yes.
N into n plus 1 by n. This
Yes, you
one.
can say that. 1 plus 2, that makes 3, 3, 3, 6, 10, and then 15. So what you're going to do is 50,000 minus 2,000. That creates a depreciable amount of 48,000. 48,000 divided by 15 multiplied by 5. 48,000 divided by 15 multiplied by 4. 48,000 divided by 15 multiplied by 3. 48,000 divided by 15 multiplied by 2. And 48,000 divided by 15 multiplied by 1. So again, this is the reducing balance method. You will see that the depreciation is being reduced after every year. This will be the depreciation expense for the first year. This will be the depreciation expense for the second year. This will be for the third. This will be for the fourth, and this will be for the fifth year. So the depreciation for each year will be reducing, but on a more of a systematic basis. Can you calculate the amount, please, Afzal, for me?
1 minute, sir. 40,000 divided by 15. Sir, first one 16,000, sir.
5,000?
16,000. 16,000, first one. 16, 16, double.
160?
16,000, sir. 16,000.
Sorry. 15,000. You are saying 15,000.
16, 16. 16. No, sir. 16, 16,000. 16.
16,000?
Yes, sir.
Okay. Sorry. I couldn't hear you properly. That's why.
Second one, sir.
12,000?
1 minute, sir. 12,800, sir.
12,800?
Yes, sir.
Okay. 48,000 multiplied by 3?
9,600, sir.
Okay. 48,000 divided by 15 multiplied by 2?
6,400, sir.
6,400.
Yes.
And the last one?
3,200. 3,200.
3,000?
200, sir.
Okay. So you get the point? It is
Yes,
another
sir.
method for a reducing balance method, but it is more systematic in calculation.
Yes, sir.
So let's come towards the closing of our workshop here. So
Double
just wanted to,
decline method. About double decline.
there is a double declining method in which the depreciation for each year, that the depreciation which you have calculated in the reducing balance method is multiplied by 2. That is why it is known as a double declining balance method.
Okay.
Okay.
No.
So there is a straight line method, there is a double declining method, and reducing balance method, sum of digit years method, and there's a units of production method. Okay. Then
Yes,
there
sir.
is depreciation for tax purposes, but that will be considered in the deferred tax. So if Daniel, if you are listening, I think this would be enough for my side. I think I have comprehensively covered everything. So if you want to say anything, Daniel, digital analytics, I think Daniel itself is hearing it.
Sir, how to
Daniel,
got a study video, sir?
yes, Sabzal,
Study video, sir. How to got, sir? Study. I do not class
you
attendance.
will get this video as well as the PDF which I have, which I am using to calculate everything. So everything will be shared in the group.
Okay, sir.
Okay.
Okay, sir. Study video, sir. I study.
It's
I am not.
posted in the posted in the group. I think it's posted in the WhatsApp group.
Everything will
Okay.
be posted in the group.
Okay, sir. Thank
Utam, was it
Sir, yes,
was
it's
the
very helpful. It's
was
very
the session
helpful.
helpful?
Yeah, definitely it's helpful, sir. I need your one suggestion. I just
Yes.
starting my CMA preparations. How can I cope up in short time? If you can give me an advice, sir. Should I go
My
through the
advice,
full
my
books, full
advice
book?
would
Yes, sir.
be, my advice would be, Tom, that you should study the book as much as you can. Because
But
I
full book,
myself,
sir, is
I'm
it
a
too much time, sir? So full book study is it too much time required? That's the
full book.
main.
No doubt, that is very much right. No doubt, full book is very low. But if you are going for a self study, okay,
Yes.
if you want to self study, then the book is the best thing. The resource is the best thing. Okay, you would need to
Okay.
spend. You wanna buy some videos, wanna use YouTube, that is another thing.
I
And
have some idea. I have some idea regarding the syllabus, but the main thing is a long gap, study gap. Okay, to me, that is the main thing. So, but I
Same
have some
thing
concept.
here.
I have some the concept. I have the concepts of
Same thing
the
for
these
me,
things.
sir.
the
So
Mm.
hook
only thing
internet. How to got PDF, sir? Hook book PDF.
you want the PDF book. Okay, I
Yes.
think Daniel would be answering this. So I
Okay.
basically would now what you would be doing, that you will be asking these questions inside the group, and Daniel will be answering all of these questions.
Okay,
Okay,
sir. Thank
he
you.
will be sharing the video, he will be sharing the PDF, everything will be shared by him.
Okay, sir.
All right.
Yes.
And regarding your query, Daniel would have a better answer for that. I think he will be able to share some material and videos to you, so you will be able to use to cope up, and that study gap will be easily be filled through him. Okay. If
Sir,
you
sir, your
want,
good name, sir.
my name is Usman.
Oh, thank you, sir. Good, sir. Nice to meet you, sir.
Nice to meet you as well. Okay.
Okay, sir.
Okay.
I think it was a nice evening. Uh,
Yes.
God bless you all. Thank you so much.
Sure.
Assalamu alaikum.
Sure. Sure. To you. To you.
Okay, sir.
To you, sir. Thank you.
Thank you, sir. Thank
Thank
you,
you.
sir. Nice to meet you.
Thank you.